everyone. It's a pleasure to be speaking about the platinum group metals today. I think it's been happening over the past few weeks. It's been pretty interesting. So I wanted to take a look at what has been going on in the near term that has been contributing to the price weakness, and then move on into some of the longer term prospects. So I'll start off with an economic overview. I'm not going to get too into it because you'll get more of an extensive overview in the afternoon with the silver presentation. Then I will discuss some of the various factors that have been influencing the near-term price weakness. And then I'll transition into some of the longer-term factors that will contribute to higher prices in the future. And that will kind of filter into just a short discussion on the supply and demand fundamentals. And then I'll close off with some price projections. So this chart shows gross domestic product of the world, emerging economies, and developing economies. And I first just wanted to kind of point out what's been going on with the emerging economies. The emerging economies has been a major source of growth in fabrication demand for platinum group metals because of the growth in the auto markets in those countries. And I wanted to make a point that between January and the April update that the IMF provides on its economic projections, they lowered their expectations for growth in the emerging economies. And this translates to lower growth in demand for the platinum group metals. Still high growth, but a little bit lower than initially expected in the beginning of the year. So some of the factors that have been influencing the price weakness, first and foremost, has been investor disinterest in the metal. This has been illustrated through physical metal selling, as well as a significant buildup in short positions in the New York futures and options market. The investors primarily buy platinum group metals as an industrial commodity, so they're looking at the capital appreciation prospects for the metals. And what they've been looking at has been the weakness in the European auto markets, as well as slower growth in Chinese auto demand. They've also been looking at the mixed commercial vehicles picture, and they've been looking at slower growth in platinum jewelry demand in China. China is the primary or the main consumer of platinum jewelry. So this chart shows the net additions of platinum, palladium, and rhodium into exchange-traded product holdings by year. So far this year, we've had a little bit of a mixed picture. For platinum, we had overall the holdings are up on the year, but in recent weeks, the dynamic has changed a little bit. So for platinum, holdings have actually been declining since March. They're down about 3% to which is about 40,000 ounces from the middle of March. And then for palladium, they've actually been trending higher throughout the year, and that is because some of the various factors that influence all the metals have been a little bit more positive for palladium. Rhodium, their holdings have actually, there's only one rhodium ETF, and that's only traded in Europe. And those holdings are up by nearly double, but that's only because it's the one ETF, it's a new exchange-traded product, and it was only introduced last year. So there's still, the market is still getting acclimated to the introduction of that product. Second, to illustrate the weakness in investor interest in these platinum group metals, is there's been a significant buildup in gross short positions in the NYMEX platinum and palladium futures and options markets. For platinum, I've highlighted the gross short position, which is in the blue. It's actually reached unprecedented levels. It's approaching 600,000 ounces, which has never been approached before. And then in palladium, it hasn't reached unprecedented levels, but it's still at very high levels. So those two slides basically demonstrated what the weakness was coming from, and here I'll discuss some of the factors that the investors are looking at that is contributing to their building up of shorts and their selling of the metal. First and foremost, I'll start off with the European auto market. The European auto market most heavily influences investor perceptions of platinum demand. This is because about 50% of passenger vehicles in the European market are diesel-powered, and diesel engines typically require higher loadings of platinum. Although in the past few years, this dynamic has changed just because auto catalyst makers have discovered ways to use more palladium in order to lower the price and the cost of the production of those applications. So since October of last year, the monthly new car registration rate has been declining in Western Europe. This is translated to lower demand from Europe of platinum, but also palladium and rhodium. Another factor that has been weighing on prices in recent weeks is the perceived slower growth in Chinese auto demand. Chinese auto demand is expected, or vehicle sales rather, are expected to rise around 3 to 3.5% in 2012. That is much lower than growth that's been seen in the past decade. Growth has averaged about 20% a year in terms of auto sales being made in the country. So this slowdown has been seen as negative, but it should also be viewed in the longer term as a positive because there still is positive growth in demand there. The commercial vehicle market is mixed depending on the regions you look at. The largest commercial vehicle market is the US, and this year so far through March, sales are actually up 10%. The second largest would be China, and sales are actually down 11%. So as you can see, the picture is mixed, and it depends on what the investors are looking at that help influence their decision on whether they think that PGMs are a good buy. Here's a little bit about jewelry demand. Jewelry demand, I mostly focus on platinum because palladium, it's only about 6 to 7% of fabrication demand is taken up by jewelry. But for platinum, it's about 25 to 30%, so it's a pretty significant factor to look at. In the past few months, we've seen a slowdown in growth in platinum jewelry demand in China. If we look at the first chart, this is trading volumes of platinum at the Shanghai Gold Exchange. It serves as a pretty good proxy or estimation of the trends in platinum demand because a lot of jewelers will go to the market to fulfill their requirements. Trading volumes this year through April are only up by less than 1%. This compares to the same period last year when they were up about 19%. And then the next chart shows the net imports of platinum to China, which are actually down 30% this year so far through March, which is a pretty significant drop. This serves as another proxy of what demand is looking like in China. China does need to import much of its PGM needs because it produces very little of the metal. So those are some of the near-term factors that people are looking at that are contributing and weighing on prices. I now want to kind of transition to the longer-term positives of the market because we do feel that the market is pretty positive in the longer term price-wise. First, I'll be talking about just the sheer volume of the increase in global auto sales as a whole. So taking a step back from looking at regional trends and looking at the big picture. Then I will look at the supply constraints, which is really the most important factor to be looking at for these markets. And then I'll kind of discuss the fact that these markets, not all of them, but at least platinum and palladium, are in deficit or expected or approaching a deficit. So global auto sales have been rising since 2009. They're expected to continue rising in 2012 and 2013. In 2011, they actually reached unprecedentedly high record levels, and that will continue through 2012 and 2013. In 2012, they're expected to increase around 3%. In 2013, about 5 to 6%. This is positive because most vehicles in the world require auto catalysts, so the demand for platinum group metals would rise by the sheer increase in auto sales. So taking a look at the U.S. auto market, this has been both positive in the near term, but is also very positive in the longer term, as the U.S. is one of the largest auto markets in the world. Sales are up about 10% this year from the same period a year ago. We expect that sales could be up about 7% on the year. And taking a look at this market is pretty positive for more so palladium than platinum, because the U.S. is primarily a gasoline-powered market, and that requires higher palladium loadings. So I'm going to move on to some of these supply constraints. I'll start off with the cash cost curve. This chart shows the PGM C1 cash costs since 2000. As you can see, the higher end of the range has been quite volatile, and overall cash costs have been increasing pretty substantially over the past few years. In 2011, cash costs increased about 9.6%, from 2010 to about $570. And since 2000, they've grown by a compounded annual rate of about 10.8%. And the reason that these cash costs have been rising so exponentially is because cash costs in South Africa have been rising very, very strongly. And these markets on the supply side are very highly concentrated. For platinum, about 80% of mine production comes from South Africa alone. For palladium, about 40% comes from South Africa, with the other 40%, or another 40% coming from Russia. So this leaves these metals highly vulnerable to developments in these countries. So it's really important to look at what those pipeline costs and supply production figures are going to look like. So here I'm going to delve a little bit deeper into some of the reasons why cash costs have been increasing so strongly in South Africa. Just last year, there was a surge in the Section 54 issuances of, these are essentially Section 54 of the Health Mining Act in South Africa. Gives the Department of Mineral Resources the right to stop production at a mine in order to investigate safety issues. And the Department of Mineral Resources has been working really hard to try and reduce the fatality rate at mines in South Africa. Last year, they decided to take that initiative up a notch, and we saw an increase in Section 54 stoppages that was much more notable than what we've been seeing in previous years. So I ran a little calculation for 2011 to see what the impact was of these Section 54 stoppages. And looking at different company reports of some of the larger or largest PGM producers, about 370,000 ounces of platinum group metals were lost due to shifts that were lost due to the Section 54 stoppages. This obviously was offset by increases in other the ramp up of production in other countries, but attributable just to those Section 54 stoppages, it was estimated that about 370,000 ounces were lost. This is expected to persist, this kind of trend. It may not be as severe as in 2011 in future years, but it is a factor to look at. One of the largest components of the increase in cash costs has been more so of the loss in production for various reasons. Production is constrained due to labor strikes, which stop production shifts due to these safety stoppages, but also because of the geological complexities in the mining of PGMs. On the right side, you see a pie chart which shows the approximate breakdown of cash costs. About 50% is taken up by labor, which has been a major source of cost increases in the past few years. In 2011, most companies saw about a 10% increase in wages, which were agreements made with the National Union of Mine Workers or other unions for their workers. Another source of major cost increase has been electricity. In 2011, electricity costs increased 25%. This was part of a 3-year tariff increase program with ESCOM. This year, we expect that increase to be about 16%. It was originally going to be 25%, but the South African government decided that they wanted to lower that rate to alleviate some of the cost issues. The rapid increase in cash costs is translated into less interest of investing in exploration in PGM projects over the past few years. PGM exploration spending has increased over the past few years, but not at the rate of total spending. This chart shows the percentage of PGM exploration spending to total exploration spending. So in 2002, PGM exploration spending accounted for a little over 5% of total spending, and by 2011, it was just a little over 1%. This translates to a weaker production capacity pipeline, and this is an important point to make because the PGM markets, when you're looking at them, the supply side is really key. As of 2011, there's about 14 million ounces of platinum group metals production capacity at mines globally. We expect this to increase to about a little over 17 million at the end of the decade. Between 2011 and 2016, we expect the capacity to increase at a 2% compounded rate, very low rate. And this, I believe, is much lower than the growth in fabrication demand that we expect. So those are some of those factors that, in the longer term, we're looking at in determining our longer-term price forecast. We do price forecasts 10 years out, and so we look at those supply-demand fundamentals. Taking a look at the broader picture, taking a step back, we see that both supply and demand have risen pretty substantially since the 1980s. We expect supply to decrease by about 1.7% in 2012. And this is a lot of this is because of the labor strikes that occurred in the first quarter of the year, and also no new pipeline capacity coming on stream. Fabrication demand is expected to continue to grow about, I think it's about 3%. I don't remember the exact number. So this translates into the platinum market being into a deficit and actually falling into a deeper deficit in 2012 of about 340,000 ounces. These are really tight markets, and they're very small markets, so the fact that they're falling into a deficit is pretty positive for the price. So that said, we expect that PGM prices will continue to face some weakness, at least through June or July, but could improve in the latter half of the year. Prices are expected to average about 9.7% lower in 2012 relative to 2011, but to increase about 6 to 7% in 2013. Moving on to palladium, similar to platinum, both supply and demand have increased pretty substantially since the 1980s. On the supply side, we also expect a decline, but only about 1% decline. There will be a decline in mine production, but this is expected to be offset by an increase in secondary supply. Demand is also expected to increase pretty strongly for palladium, and that is because there has been a lot more strength on the side of palladium in auto demand. So the U.S. market has been strong. There's been continued growth in Chinese demand. Those are primarily gasoline markets, and they're the largest auto markets, so that's been a little bit more for positive for palladium prices and demand. So the palladium market could fall into a small deficit in 2012. This would be the first time since 2000. I do want to point out that we're still working out our statistics, so we're still measuring to figure out if we think that the market could be in deficit. But the point to drive here is that it has been approaching a deficit over the past few years. So similar to platinum, we do expect continued weakness over the next few months, but to see a rebound in the latter half of the year in 2013. Prices are expected to average about 9.2% lower in 2012, but to rise a little bit more forcefully than platinum in 2013. Now, I didn't discuss rhodium too much in the presentation, but I wanted to touch upon it right now because it's been kind of an interesting market to look at over the past year. The price is about half it was last year, and a lot of that weakness is because this market is very, very highly concentrated. About 80% of its demand comes from the auto sector alone, and we've seen that slowdown in demand growth really translate to much lower prices for rhodium. We do expect price to rebound in the latter half of the year, similar to platinum and palladium, and to rise a little bit more slowly in 2013. But this is because this market is actually in a surplus still, which is different from platinum and palladium, which are both approaching either in deficit or approaching a deficit. Okay, I guess the last slide I don't have, but thank you for your attention, and I will be accepting questions. I do want to point out that our Platinum Group Metals yearbook will be released on the 26th of June, and that will contain our final statistics for 2011 and projections for 2012. Okay, so I'll take questions. Yes.
Thank you. On the platinum supply and demand slide, you said production is in deficit or is approaching deficit, but the price is to decline in 2012 with strong demand.
Yeah.
Why would the price decline with strong demand and supply approaching deficit? It seems that that's there's something wrong. So could you account for factors of why this is occurring?
Yeah, it's kind of a mystery, but not really. So the surplus deficit represents the excess of supply over fabrication demand. It does not include investment demand. And what we've been seeing in the past few months is weaker investment demand. So investors are looking at the negatives of the markets and selling on that or not buying. So it's been mostly a function of weaker investment demand. Yes?
Follow-up question. Follow-up question. In what way do investors invest?
So right now, I believe that they're not looking so much at the very positive supply situation, positive in terms of price, and they're really focusing in on the weakness in the different portions of fabrication demand. So because these metals are primarily industrial metals, they're looking for capital appreciation prospects, and they're seeing that there's a weaker demand. In the case of platinum, which has been suffering a little bit more than palladium in recent months, they're looking at the European auto market, which has been weak.
My question wasn't clear, and I have to apologize. Is it the paper market or the physical market that the investors are investing in? Both.
I had shown a chart earlier in the massive growth in gross short positions. That would be the paper. And then I also was looking at the physical demand looking at the exchange trade product holdings, which has been weaker for platinum, a little bit more positive for palladium.
Follow-up question. Do you believe that they're going to decouple the physical market from the paper market, or will the paper market continue to drive the physical market?
I think we're already seeing investors buy physical ahead of a reversing trend in the paper market, and that's usually what happens. Physical buyers typically look for more bargain opportunities. The paper are kind of chasing the price.
In what form are they buying in the physical market?
I would say bars, but mostly ETFs. That's more of that lower level retail level. We have a. Do we? You're welcome. Do we have one more question or?
One more question.
Yeah. Hi.
When you do your analysis to see if the market is in deficit or not, do you take into consideration the secondary supply that is coming in through recycling catalyst?
Yes,
Yes.
we do account for that. I didn't discuss it too much in the presentation, but in 2011 we saw growth in secondary supply for platinum, palladium, and rhodium. And in 2012 we do expect a decline for platinum, and that's just because of the changing dynamics of the loadings of platinum group metals in autocatalysts. We're starting to see more palladium be recovered than platinum in autocatalysts, and that's just because of the technological innovations that took place in the 1990s. So we're seeing a lot of those autocatalysts come in now.
Okay, thank you.
You're welcome. Thank you.